So good morning, good afternoon, good evening, bon dia, everything in all the languages. Thanks guys for coming here. It's a lot of people today. That's pretty good. Today I decided to do a little bit of different sort of week ahead and focus on in three things. More the critical ones, more the critical economic events. That will be definitely, shaping the week, shaping the pretty much the last 15 to 20 days of the month and the beginning of the next month. So we're going to be focusing on the FOMC rate decision that's going to be between 18 and 17 of March. Just depends where you're at. So for me, will be tomorrow, the 19th, I think like 6 in the morning or 5 in the morning, something like that. Then we're going to be looking to the Bank of England and analyzing some market expectations, inflation dynamics, and moreover, the broader dynamic of the implication into different asset classes, into different financial instruments. So before we go any further, of course, and the global economic considerations, I guess in an overall, we do have OECD and all of those things that we should be talking about. Like UK annual economic growth forecast and some of those things, and then of course the conclusion, and then we ended up. Okay, for those who are new, I do see some new names here, so welcome. It's a pleasure to have you guys here. But if it's your first time, please, if you have any questions, just let me know. You can open your microphone, or if you want, you can just send a question. You can just send a question on the chat. It doesn't really matter to me. I just need you guys to participate the maximum as possible, because it's really good, but really engaging, and the time flows much quicker, and we always going to be learning from one another. Okay, cool. All right, so let's talk first about the FOMC. All right, so that's the CME Fed Watch Tool. For those who don't know, that's a tool that, let me send the link first on the chat. Where is the chat? Can't have, oh, there you go. CME tool. So you guys can access it, it's free. No charges involved, and it's really, really helpful. So on the top here, I always talk about that tool, but don't teach anyone to use it. So let me just run through very quick, because we have a lot to talk. I don't waste much time, but this part here, where you can see black, well, maybe let me change the color to like a pink so everyone can see. Yeah, so on this area here, it's the days of the meetings from the Fed. Okay, so the next one, of course, 19th of March, and then 7th of May, 18th of June, 13th of July, 17th September, 29th of October, and 10th of December, and then 2026 for the next one. They already have the meeting is scheduled. Okay, so that's very important, because from here, if I click on the 19th of March, that's exactly where I am at the moment. You can see the current target rate is at 425 to 450. Remembering that the interest rates, they are a two-way sort of thing. Okay, so you have the low, you have the high and the low. So in this case, the highest point it could be is 4.5, and the lowest is 4.25. Okay, so that's a range. We call this the range. Okay, so it can fluctuate on the middle here. Anyways, so that's the current target rate, and then we can see how much of the people that were interviewed or have the Chicago Mercantile Exchange swaps rates, overnight swap rates, they have voted to the Fed will pause or the Fed will cut or whatever. So in this case, 99% is expecting to be maintained at the same level. See, exactly same level here. So we can see that those levels are exactly the same. As of those levels are different. And then we can just do a quick math, and then we will understand how much they're pricing. So in this case, 425 to 450, and then 4 to 425. So basically 25 basis points cut. Only 1% is expecting that to happen, okay? So bottom of the line is that majority is expecting a pause, so no changes from the FOMC. Why do I say this tool is helpful? Because if, right, the market comes in, if John Paul comes in and do a cut, and only 1% of the market is expecting it, that's going to be huge, and the US dollar will be really strong. If he hikes and 99% is expecting, if he cuts, it's going to be bearish, and if he hikes, it's going to be bullish. Okay, so that's pretty helpful. But if that happens, so nothing happens, a pause again, nothing will happen because it's widely priced in, and that's most do it because of the inflation. So we can see previous data as well. So if you look here, the target rate on this part here, we can see that now is pricing this for this. It always change. That's why I'm calling this. So 1% for 4 to 425 and 99% for 425 to 450. And then 1 day ago, that was 2%. 1 week ago, this was 4%. And 1 month ago, this was 3%. So not much changes. So widely priced in. You know what I mean? That's very expected. Okay. So, just coming back. Oh, yeah, of course. And then you can go over the date. So 19th of March, you can go to 7th of May. And then again, just do the same thing. 425 to 450, the current rate. And then 425, 450, 81%, 81.8%. So no changes again. So no cut on May. And then June, we do expecting a 25 basis points cut, 57.3% of the market. So one cut for the year for June. And July, remembering that it's the new normal. If that happens, it's going to be 4 to 425. So here, no changes again, 4 to 425. And then this one, another 25 basis points cut, 375 to 4%. October, nothing changes again. And then December, maybe it changes or maybe not, because that's very close. But at the moment, no changes. So expecting 2 cuts, 1 in September, so 1 in June, okay, and 1 in September. Right, so that's pretty much it. That will help us. Okay, so we're very close to the FOMC, and we have to be prepared. Okay, it just depends on your time zone. It can be on the day 18 or the 19 in the morning. But markets, consensus, as we can see here, are expecting that the Federal Reserve will maintain the federal funds rate within the current range of 425 to 450. And that expectation, pretty much comes from the confluence of some mixed economic indicators that the Fed will be evaluating on the day of the rate decision. And if we look to some recent data reviews, we can note some sort of deceleration in consumer spending. So yesterday, let me come to FinLogic's economic calendar. So finlogics.com. It's a sister company from ACY. You've got a bunch of things here. You got charting, you got some tools, economic calendar, earnings calendar for you that trade stocks, market sentiment. We do have a webinar on Wednesdays that I do trade market sentiment. So, we've been pretty profitable so far. It's a very nice and very easy to use strategy. So if you guys want to, come on board tomorrow, 5 to 6, same time, and then some financial widgets, but that's for more for business and etc. Then news, just some news and commodities, indices, etc. And then you can have the blog, ebook, glossary, and then the pricing if you want to buy the freemium version. But for us, what we want is the economic calendar for now. So let me send that on the chat for everyone. There we go. Economic calendar. Yeah, send it over so you guys can have a look at it. But I've just selected US, okay? Just US here. You can click on select all, and then you can click on whatever currencies you want. And then I will leave on just median and high. And then I click on this week. And then I have a look here on retail sales. So retail sales yesterday, 11:30 p.m. for us in Australia, came up to be 0.2% from the forecast 0.6% and reduced it down to negative 1.2%. Same goes for the next retail sales as well. But that's some sort of mixed data, as we can see. But it's, the consumer spending is decelerating. Okay, it's having some deceleration. In February, as we can see, the US retail sales sort of added up by modest 0.2%. And that's like falling short of the projected 0.6% increase that we were looking at. And that shortfall raises a lot of concerns about the, I would call that the robustness of the consumer demand. And I've made a video that on the YouTube today. You guys can watch that later. I can send the link soon. But the consumer demand it's one of the main drivers of the economic growth in the US. And notably, the spending at restaurants and bars, they've declined by 1.5%. And that is signaling some potential shifts in the consumer behavior. And that's why I've mentioned to everyone, it's always very important to be looking at the retail sales, because that has some good numbers to show us who is spending more and when they're spending more and where they're spending more. So if you want to have a look on those exactly topics, it's very easy. You can just go into BLS, retail sales, data, and then you will have the consensus.gov over here. And then you can just click on monthly retail trade. And then you have over here, okay? You can come to information data. Oh, sorry, it's right here in my phone. So let me just zoom in a little bit. So you can sort of see the December, January, and February, like excluding automobiles, auto, and German merch. So in February, we can see it right here. There's 1, 2, 3, 4 right here. The auto, people spend much less in auto, okay? Excluding auto, of course, up move. Total, a little bit below than what was in December, for instance, of course, because December is festive dates, and always it's like that. But what's most interesting here is that the January figure has been revised, okay, and it was revised to negative 1.2%. So total of $721.3 billion is spent. And in February 7, 2022, $0.7 billion spent by the consumer, okay? So that's a pretty interesting website. You guys can come here and have a read on those later on. I can send the link on the chat. Just a second. Retail data. Sent. Cool. But coming back, as I was saying, there were some slowdown on the bars by 1.5%, And that sort of signals me some cautions warning. But in the next topic, in the next point of it, because we do have the retail sales and then we have the inflation. Inflation remains one of the biggest considerations on US economy at the moment, because there's a lot of talks going on about, a lot of rumors going on about a potential recession happening into the US. When we look to the consumer price index, that is the CPI, it pretty much indicates that the inflation is gradually aligning with the Fed's 2% target. So, however, it's very persistent. And that persistence of, those elevated prices, particularly in like essential goods and services, it necessitates ongoing vigilance from the Fed, I would say. And the recent implementation of the new tariffs by the Donald Trump administration, it has introduced additional inflationary pressures. And that is complicating the Fed's policy deliberations, because think about one person is working to bring inflation down, and then someone comes over and, it's like you cleaning a whole mess. Imagine that. You cleaning your house, you mopping the floor, and then soon as someone opens the door, they don't even care if the floor is wet or not, and then they just step on the floor, and then you have to clean over everything again. That's exactly what Donald Trump's doing, because the Fed is trying to bring inflation down, controlling inflation, at the same time easing monetary policy. And then Donald Trump comes in, implement 25% tariffs on Canada, Mexico, 10% in China, looking to implement more into Europe, 25% aluminium and steel imports and exports. So it's becoming a whole mess, and that's generating more inflation. And I've mentioned that like 2 months ago in January on one of our first webinars. I've mentioned that, look, inflation will be much more stickier at the moment because we have someone working to bring it down, and then the other person just doesn't seem to care. So I don't know what Trump wants. I don't know if he's doing purposes, because he has a big ego, and I don't think he would allow those stock markets and everything else to be at the price where it is at the moment. But anyways, in my opinion, it's complicating the Fed life in real world. I think the Fed will have much more problems and much more things to solve that than just trying to take care of one thing where they're going to have like 10 things to take care. The labor market exhibiting some resilience. We had the NFP 2 weeks ago. Unemployment rates, they are hovering around the historic lows. Someone sent a message. Tweet says that the tariff was making sense to me beginning from last year, but now it's becoming annoying. Yeah, I mean, I've mentioned that, right? It's not good. It's not good at all, because market's going to be fearing of trade war, right? Because if he did that, then he can do with anyone he wants. If he did that with Canada, Mexico, China, looking to do with Europe, he can just do with Australia if he wants. He can just do with South Africa. He can just do with Russia, Ukraine, whatever he wants. Brazil, Mexico already doing it. So he can do whoever he wants. And the problem here is not that. The problem is those countries fighting back with tariffs, like Canada is doing, for instance. Canada have mentioned very clear that whatever Trump do on sort of tariffs with Canada, they will do it back. So if Trump implements 100% tariff on Canada, Canada will implement 100% tariff on Mexico, on US. So that's really not good, because that's called a trade war. And when a trade war happens, economy gets really bad. to don't say another word. Yeah, so it's gonna be a mess, and I don't want to be there. Aditya said Trump's doing ego boost. Yeah, exactly it. So it says it's like the market ignoring all the important data and waiting for tariffs. I agree in a sense, because that's all what the market cares at the moment. They not looking at much at before. Look, I've said that, and I'm going to say that again. Say that before, I'm going to say that again. Forget about last year trading. Forget about 2023, 2022, 2021. It's a completely different market. Market will be looking to different aspects of economy, and different rumors, different temptations, different outlooks. It's completely different. We do have a completely whole different organization into the White House. So I guess it will be a very tough year for everyone, but a lot of opportunities as well. Where lies volatility lies opportunity. But anyways, as I say, the labor market is some sort of resilient with unemployment rate very close to historic lows. But nonetheless, there are some emerging signs of moderation in the job creation and wage growth, which could influence the Fed assessment of the economic momentum, because unemployment rate, NFP, job creation, in a sense, it's really, really close to watch by the Fed, because that way they can measure if the momentum of the economy is getting hotter or colder, and how is the population? Because if there is more job, there is more money in circulation, and if there is more money in circulation, there's more spending. If there's more spending, there's more inflation. If there's more inflation, there's higher rates for longer. If there's higher rate for longer, the economy gets hurt more. The economy gets hurt more, people will suffer more. People suffer more, they hate the government. If they hate the government change. The government change, everything changes again, and that goes everything again. Okay, so it's not hard to understand. It's pretty simple. Everything happens again and again and again, but just on a different sort of package. Just a different package, but same product. You know what I mean? Like they change the package, but they don't change the recipe. That's exactly it. So, in my opinion, given those dynamics, I think the Fed is more and more going to be adopting a cautions instance, and they will be keeping the interest rates steady at this moment. I don't think they will cut or the rates. I think they will be holding the rates again, while they will be monitoring the income data to take future policy decisions. So what can we take from that? What would be the financial impact on bonds, stocks, US dollar, whatever? So let's talk about bonds first. I was doing an analysis on this stock from Brazil. I'm long on EURUSD. I don't know why, just for fun, I guess. I was doing an analysis on this stock from Brazil. That's kind of an interesting stock, because look at that, just out of content, but the stock was trading at one. But let me make this dollars, because that's in BRL. Let's see, USD. Perfect. So now you guys can sort of take it. So that was trading like $1.75. Long time ago, my friends. Like here, $1, pretty much $1. And that was 2017. Since then, the market pretty much raised all the way from here to here. So that's like 5,682% in around 17, 18, 19, 20, pretty much 4 to 5 years. Okay. And then the same way it went up, it just went down 50%. Okay. And I'm looking to this to at least like double the price. At least go somewhere around like $4, around $4, I guess. But that's like Magazine Luiza. That's from like Brazil stock market. Anyways, just for fun. Crash dump it, yeah. It's a big company in Brazil though. Okay, so let's talk about the yields first. Perfect. Okay. So we have here the 10-year, somewhat consolidated at the moment. But anyway, so the Fed policy trajectory, it will definitely influence a lot of asset classes, and the first is going to be bonds, as we always know. Think about it, right? If we have these stable interest rates, that suggests that the US Treasury yields, it may remain relative unchanged in the short term. But if we have any kind of shift in inflation expectation or economic outlook, that could lead to some adjustments into the bond yields, okay? Because bond yields are very sensitive to forward guidance in a sense. It always happens first on bond yields and then happens from the Fed or happens from the economy. And I'm saying that because, yes, we won't have any changes tonight or whatever where you at, but that means we won't have changes on the yields as well. But if we have some changes over the rhetoric from Jerome Powell saying that the inflation is expected to decline quicker than what they were analyzing before, then that will be really interesting. Then that will be good for the yields, and yields will be probably dropping a little bit more, okay? Now, the next one is the US dollar, of course. We had a pretty big fall, I would say, 3.5% to 4%. Yeah, around 4%. If we count to the highest to the lowest point. Hey, Luca, can you tell me more about GBPJPY? Yeah, I can have a look on that later. So the US dollar, some big moves in the last couple of days, pretty much in response to the interest rates expectation, as well as the geopolitical developments. So the market is very sensitive to the Fed at the moment, and any policy signal that the Fed do. I think if the Fed sort of, makes it very clear that they are not expecting rate cuts anymore, or if they are expecting rate cuts and how much they are expecting rate cuts, because that's definitely a question that will be asked from the journalists, okay? I think the US dollar has some more space to continue to fall, okay? Until where? Well, I know you guys know I'm not much into a technical perspective, but I mean, look at this. I think it's pretty clear to see that we're coming back down to the 100 area, okay? Somewhere around here. So what can we do? We can continue to long euro dollar, because if we go to euro dollar, you can see there's definitely a target over there. Okay, at 111, or maybe even 112 if you want to, maybe 111. Let me check here. Yeah, 111. Maybe 111, I guess, would be the target for this scenario. I guess I would be looking to long euro dollar at the moment. Lots of people have been looking at the social media. Lots of people are looking to short euro dollar. I guess it's not the time yet. I guess we can probably come to 111. Okay. It's like they say, buy on the fear and sell on the rumors. So that's pretty much it. Anyways, so yeah, I guess from the Fed, just to wrap up here, too much time already on the Fed. With the economic situation, how they're traveling and how they are, how they are going with the tariffs and everything else, I guess we're going to be having some higher for longer. Expected only 2 more cuts for this year. So in general, we're expecting 3 cuts for this year, and that's exactly what Raphael Bostic said, 75 basis points. We did have some aggressive cuttings last year, so not going to be the time. Again, something happens. If something happens on inflation or the inflation perspectives or anything related to the job market momentum losing some traction, then yes, maybe 4 to 5 cuts, but I guess it's too much. It doesn't get right, that number 4 to 5. I guess 2 to 3 it's already enough for this year. Okay, so I guess on a weaker US dollar at the moment and long in euro dollar until 111 would be a good trade. Now, let's go for the next topic. And the next topic, it's an interesting one. It's the Bank of England monetary policy. We're going to be having let me just change it here to United Kingdom. And we have the BOE interest rate decision on Thursday for myself in Australia, right here. And they're expected to maintain the same. So no changes on the monetary policy. Sorry, I had to drink some water. What did Aditya want me to do? A GBPJPY. Okay, that's the moment. What are you doing here? You longing or shorting it or? Long. Okay. Yeah, you should. Let's go for the 4 hour. Okay. Oh, one thing I want to just give you some snippets here. Maybe some of you will be like, what are you talking about? But anyways, what you guys can see here, that's a daily chart. You can see candles, right? Or if I change, you can see a line. Or if I change, you can see, I don't know if I have access to that. Yeah. But anyways, you can see whatever is on the screen. But I can see the price, like 194.384. So what about if I go to the 1 minute? What can you still see? You can still see candles and you can still see the same price. So what's the matter of changing time frames? there's no point, because what you're going to see on the daily is exactly the same you're going to see on the 4 hours or the 1 minute or the 30 seconds. It's the same price. The price doesn't change. It's just a different representation of a chart pattern that you will be looking at, and maybe you will be illusionizing yourself with that, when in the end it's just a pattern again. And if you look at one pattern and then another person looks at the same chart, they will see a different pattern and they will looking to change the rhetoric. So fundamentals don't let you lie to yourself, and that's why I'm here every Tuesday, Wednesday, and Thursday to teach you guys that. But anyways, okay. So for BOE, so turning to UK at the moment. So the Bank of England, as we say, they have the interest rates decision on the 20th of March, at least for me. Maybe for you it's on a different day. And they will be, well, actually, let me check. Interest decision 4545, but I've seen in another economic calendar that they're looking to cut. Just a second, guys. Sorry for that. I just need to give you the correct information. No, that's correct. Yeah. Okay, so the economic plan there is longer. So they are most likely looking to have no changes. Okay, and what prevents from February they had a 25 basis points reduction, which brought the interest rates at the moment to 4.5%, and that's pretty much prevailing the sentiment that the MPC, the Monetary Policy Committee, will maintain this rate in the upcoming meeting. If we look to UK economy, it's really complex at the moment. We can paint a really complex picture with that because in January this year, the economy contracted by 0.1%. And that was primarily due because of the weakness in the production as well on the construction sector. And the inflation, it shows some progress towards the bank 2% target. The core inflation remains a little bit somewhat elevated, and that's that's making the bank to have a cautious approach towards the MP, the monetary policy. So I guess, in my opinion, that what would be very important in this monetary policy will be what the BOE chairman, that I forgot the name, say on the inflation and on the jobs towards the construction and the production sectors. Because remember last year, UK nearly had a recession, technical recession. So my opinion is, if they maintain the same, nothing will change. Exactly nothing will change, but we need to be careful with what they say. If they say that they have rumors about inflation continue to be sticky, especially the core inflation, it's the most available measure of inflation we have at the moment from any country, excluding volatile items and leaving only what the central bank can control. That's very important. Okay, if they say that they can't control it or something is happening, then it's going to be a mess. It's going to be a problem. Okay? Now, I do believe on a stronger pound against the yen. Okay, most likely somewhere around 196, around here, 196, just chasing the next level, I guess. Okay, so it would be pretty interesting to see that going on. Now, just a global economic consideration that I want to give to everyone. USD CAD. I can do that later. So the global, I would say, economic landscape is with a lot of uncertainties at the moment, particularly concerning trade policies, as I've mentioned on the beginning of the webinar. The OECD, they have downgraded growth projections for the UK economy, and their projection, they're citing escalating global tariffs were initiated by the Trump administration, and that's the UK annual economic growth now it's forecasted to, well, it was forecasted to 1.4% for this year and 1.2% for next year. So that's reflecting a very adverse impact of the trade tensions. And that's exactly what I've mentioned. It's not about US being richer or whatever. They will really put the word down. So basically, just to finalize, in conclusion, in summary, whatever you want to call it, both the Federal Reserve as well as the BOE, they're going to maintain the rates. They're going to maintain the current interest rates. There's a lot of mixed economic uncertainties, mixed economic signals, and a lot of problems going on at the economy, both of them. So as well, the inflation trends, the consumer spending patterns are changing. The geopolitical developments they will remain a very pivotal in shaping the monetary policy from any central bank around the world, especially from the Fed and of course the BOE as well. But you guys should stay very awake with any headlines. Do follow Trump on X, do follow Trump on Instagram, follow Trump on Facebook, YouTube, Elon Musk, Doge, whatever, everything. Because whatever they say, these factors, they will bear a very significant implication for the market, okay? So just to finalize, someone asked about US dollar CAD. I mean, CAD is really, I would say, depends, because if we get, for instance, NZD CAD, right? I've mentioned about the long here. If we get NZD CAD has been raising quite a lot in the last couple few hours, as we can see, since the opening on the Monday. Here, since on the opening here, we've raised quite a lot. But if we get US dollar CAD is stronger against the US dollar. What's going on? Well, everyone knows that Canadian dollar is a big export of oil, right? And oil has been pretty bad. So most likely what will happen is, depends what you want to trade. I would say, let's say Aussie CAD as well. Another good example, like Aussie CAD has been going up crazily since open. Open. Monday. Since here, see, it's pretty much going higher and higher. So I guess it's a difficult market to trade CAD. But if you want to really trade US dollar CAD, I mean, trading short would be the best opportunity, in my opinion. That's not a personal financial advice, just in my opinion, until somewhere around 1.42. And yeah, Euro CAD. Well, not touching that. Yeah, wow. Anyways, that's insane. Yeah, USD CAD. Okay, so I guess we come up to an end. So thank you for your attention. Thanks for everyone to come. Welcome for the new people. I hope everyone has liked it. And yeah, I look forward to look at everyone here back tomorrow, 5 to 6, be live again, and chat to you soon, guys. Thank you so much. Enjoy your days. Enjoy the rest of your days, or if you're not coming tomorrow, your week, and see you back there. See you guys. Bye-bye.